Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Well, we did see a sharp recovery from the lows around 250 points, and now we are off around 140 points from the highs of the day as well. Mid-caps, they are under pressure yet again. So after a recovery, there is some fall from the highs. So it'll be interesting to see the last 2 hours of trade today.
Very interesting to see the last 2 hours of trade, and also we are nearing the end of the earnings season, so earnings are coming in very thick and fast, so important to keep an eye on that as well. Quite a lot lined up on the show. Let's start off with the top headlines. Volatile day of trade, the Sensex and the Nifty give up midday gains to trade flat, IT and financials gain, while pharma and metals drag. Midcaps underperform.
Positive commentary boosts stocks. Shares of Ola Electric zoom despite reporting a miss in the second quarter. Chairman and Managing Director Bhavish Agrawal tells CNBC-TV18 that the company is on the path of profitability and that issues regarding the service backlogs are all behind them.
GE Vernova T&D India locked in 5% upper circuit today on the back of strong performance in Q2 FY25. Company's revenue, EBITDA, net profit at multi-quarter high.
Biocon surges in trade after the US FDA grants a voluntary action indicated status to its biologics manufacturing unit in Bengaluru. The inspection, which included 6 separate biologics manufacturing units, paves way for new product approvals.
MapMyIndia dips in trade on the back of a muted performance in Q2 FY25 as profit declines while margins also saw a sharp contraction. Management tells CNBC-TV18 the company is confident of achieving rupees 1,000 crore revenue run rate by FY28.
Okay, all right. So let's talk about the markets now. As I pointed out, there was a swift recovery from the lows and there's a fall from the highs from those levels as well. We are very close to that 24,000, to going below the 24,200 mark right now. So we'll be tracking those important levels as well. Nifty IT and banking index continues to do well, but the mid-cap index, that's under pressure. So let's go across to Hormaz. He is here with our segment Mid-Cap Movers. Which are the stocks on your radar today, Hormaz?
Some pain seen in the broader markets, even as the benchmark indices are fighting to hold on to some gains. We start off with the losers then within the broader markets. And stocks like Tube Investments has fallen the most in a year now in today's session, 7.5% lower there. Sundaram Finance extending its fall post-earnings. UPL and Sonata Software also not having a good day. PSUs have reported a lot of earnings over Friday and the weekend as well, and earnings reactions coming in there. Shipping Corporation, the top gainer on the Nifty 500 now, 10.5% higher. PFC, analysts are expecting the stock to touch levels of 680, showing up in the stock price and data patterns, a negative earnings reaction. On the non-PSU side as well, there are plenty of earnings reactions like the likes of CE Infosystems. We just spoke to the management a few minutes ago. Aarti Industries now down 8%, Whirlpool's down 6%, and Aurobindo too not having a good reaction to its results. Stocks that are doing well on the back of volumes, and they are mostly news flow driven names like Biocon and ITI, IFCI and InfoEdge also seeing healthy gains of up to 5% on the back of strong volumes. And stocks related to the MFI space, the stress seen there showing in the earnings reaction and management commentary as well. Equitas and Utkarsh still trading with losses of around 4 to 6%, but Satin Credit Care has recovered from the lows of the day but still in the red. Back to you guys.
Thank you so much, Hormaz, for that. You know, the last slide that you have, the MFI stress, something that's been alluded to by quite a few lenders. But moving on, Cummins posted better than expected revenues and profits in Q2, shrugging off concerns over the impact of transitioning to less polluting CPCB4 gensets. To discuss this, as well as the way forward, we are joined by Shweta Arya, the Managing Director at Cummins India. Good afternoon. Thank you so much for joining us. For Cummins, this was an important quarter as this was the first quarter post-implementation of the new emission norms. You've seen strong growth this quarter. Could you help us break down this growth, both in terms of value as well as volume?
Yeah, thanks for that question. In terms of this quarter that went by, we saw growth across all our segments. So as you said, definitely CPCB4 Plus. This was the first quarter where we saw entire shift to CPCB4 Plus. Although the norms were announced last year, July 1st, 2023, but July 1st, 2024, we shifted completely to CPCB4 Plus. Now, same quarter last year was definitely impacted in terms of volumes because we had to revive CPCB2 supply chain as well. So this quarter saw the full impact of CPCB4 Plus, definitely. That is one reason. The other is in the non-CPCB4 Plus range in power gen. which is the higher horsepower above 800 kilowatt hour, we saw good demand, especially from sectors like data centers. And then our industrial business also showed very good growth coming in from the construction market, from the railway market, and good execution at our end. Our aftermarket business, which has been steadily showing us growth over the last few quarters, also performed well. So the growth is attributed to all of these factors.
Okay, Ms. Shweta, last time when there was such a transition, the industry witnessed price wars with competitors now introducing their CP/CB4 Plus compliant products. Is this something which you think will repeat? Do you see any downside risk to pricing because of that?
Now, all of us, all the players in the market have launched products starting from July 1st of 2023 up till July 1st, 2024. So everyone has had a chance to introduce their full line of products. I would say that when we transition to newer emission norms, there is definitely a time period where the pricing settles down in the market. So we have not yet seen the full impact of the pricing settling down. I would say it would take another quarter or maybe two for the pricing to settle down in the market. That's what I would think.
Well, talking about pricing, how are your products priced versus your competitors on an average? What's the price elasticity or inelasticity for CP/CB4 Plus products? Would you have to readjust pricing or hold on to your market share?
So price, as I said, will take some time to settle down in the market. We launched our products July 1st, 2023. So we've had this 1 year to work on our supply chain, to work on our products, to make sure that our customers pay the right value for the products. And we've had a chance to work on cost management of these products as well. So we definitely think that we are well prepared. We are providing the products to the market at competitive pricing and also providing value to the customers. Definitely, with more players in the market, pricing does come under pressure. And we are continuously working on cost management efforts so that we can be competitive in the market.
Okay, so you had guided for around 13 to 14% growth for FY25. That's twice the GDP growth rate. Do you still hold on to these numbers?
We are holding on to twice the GDP growth rate, definitely. That's been our strategic push internally, that all our segments need to look for and move towards double than the GDP growth in the country. So that's definitely been our strategic push and continues to be so.
Well, another important segment is the export space. Although it's been a mixed bag, it has risen quarter on quarter for the last few quarters. Do you think you will be able to sustain exports in Latin America as well as Europe? Or do you see any downside risk in the rest of the markets, especially Middle East, due to ongoing geopolitical conflicts?
I would say that the geopolitical situation is still playing out. There are different markets which are behaving differently due to these geopolitical situations. And there is no one reason, right? So there are different issues happening in different markets. Definitely, we saw in the last quarter that Europe and Latin America showed us some signs of improvement. We have been saying for the last few quarters that we do believe that exports have bottomed out. So we are definitely optimistic, I would say cautiously optimistic, because we are watching these geopolitical situations unfold around us. And like I mentioned, there's not one single reason that can be attributed. So various factors at play. It's a mixed bag as of now.
Okay, the other objective that you have is to improve your margins by 100 basis points. Is it at the gross level or you're talking about the operational EBITDA level?
We do aim for that at the gross level.
What's your outlook for EBITDA margin in H2, given that H2 FY24 has a high base on account of pre-buying? Our margin has been around 22% on an average.
What I can say is that we are still seeing demand in the power gen market, specifically in the sectors like data center, manufacturing, commercial reality. We are seeing good demand from the industrial business in the construction and the railway segment. Our aftermarket business continues to show steady demand. And internally, our focus on cost management continues. So the endeavor is to hold on to that kind of growth and those kind of margins.
So just a follow-up here, a clarification. In FY24, EBITDA margins were at 18.5%. In second half, it came in at 22%. Do you think you will be able to hold on to these 22% margin level?
There might be certain challenges to that because we are still seeing CPCB 4 plus pricing play out into the market. I also mentioned that we are cautiously optimistic about the exports market. So it remains to be seen how this mix plays out and how it impacts the margins. So that remains to be seen.
True. Data centers is a huge opportunity as far as the Indian market is concerned. What's the total addressable market for your products as far as data center business in India is concerned? And what percentage of your power gen revenues could it potentially contribute going forward?
So data centers absolutely is a growth segment for us. And we are focused on the market. We definitely have a technologically good product for this market. We have great aftermarket service for our customers and good customer relationships. So we are looking and we are focused on this market. How this will grow for us, it is definitely a growing segment both in India and in the other global markets. And we do export some of the products for the data center markets from India as well. So growth in the domestic data center market, growth through exports as well. Also, what share could it contribute to our power gen market? There are other segments in the power gen market which are growing as well. So the manufacturing space, the commercial reality space, all of these are growing as the data center grows as well. As of now, between 10 to 15% of the overall power gen revenues are contributed by the data center segment. And a few years ago, it was in single digits. So we definitely expect the data center business to more than double for us. How much it will contribute to power gen segment remains to be seen. That really depends on how the other segments grow and what they contribute to the domestic power gen market growth.
All right, Ms. Arya, take that point. Thank you so much for that comprehensive interview. That's the word coming in from Cummins, holding on to their growth guidance of 13 to 14% in FY25. With that, let's move on. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on November 14th, starting 10 a.m. onwards, a power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only and only on CNBC-TV18. Welcome back. Well, quarter 2 FY25 was a good quarter for Samhi Hotels on the back of strong operational performance and lower finance cost. To discuss this in detail, we have Ashish Jakhanwala, who is the Chairman, Managing Director and Chief Executive Officer of the company, joining in now. Ashish, good afternoon. Thank you so much for joining in. Well, it's been a good quarter for you in terms of operational performance. Can you give us a sense of your FY25 revenue, EBITDA and finance cost target, because finance costs led to better profitability this time? And what is the rate at which each segment is growing, be it medium, upscale or upper scale as well?
So thank you so much. You're absolutely right. We had a strong quarter 2. Actually, if you see both quarter 1 and quarter 2, revenue available per room grew upwards of about 13-14% in our portfolio across all the segments. For quarter 3 and quarter 4, we expect to maintain similar growth rates in RevPAR. All of our core markets, which are largely the key commercial centers in India, continue to have very strong demand from business travel. So we expect to maintain that, I would think, early teens RevPAR growth across our portfolio. We're not giving any specific guidance in terms of revenue and EBITDA towards the end of the fiscal year, but we do maintain a double-digit growth rate on revenue.
Double-digit growth rate on revenue. Now, coming to the important part of your portfolio, analysts are waiting for a turnaround as far as the AC/IC portfolio is concerned. What is the update over there? And in terms of operational efficiency, can you give us a few targets that you've set for yourself by the end of FY25?
We acquired ACIC in August or September of last year. And if you were to see the first half of FY24, this portfolio had a margin of about 30-31%. As of the last quarter, we've reported a margin of 36% in ACIC. Our broader portfolio is at about 40% EBITDA margins. And we do expect that by the end of this fiscal year, ACIC would have gone to touch that circa 40% EBITDA margin. That's only part of the story, right? The second part is what we are doing in terms of enhancing the revenue potential of these hotels. So of the 6 hotels we had acquired, we've signed management agreement with Marriott for them to be managed by Marriott now. And therefore, we expect 4 of those 6 hotels to start seeing better revenue generation, largely on account of improved average room rates. But the other 2 hotels, the one in Pune and one in Jaipur, we're actually expecting them to be completely repositioned as we rebrand those hotels. So ACIC's true value is going to be leveraged over the next few quarters. The first is through margin expansion. The second is going to be through improving the average room rates in that portfolio. And the last bit is going to be through rebranding of 2 of the 6 hotels, where we've always seen material uplift.
Okay, so once that does happen, more rebranding and better margin expansion, what will the consolidated margins look like for your business overall? Because the margins have also been improving.
So EBITDA margins, we are targeting to be upwards of 40% on a sustainable level across the portfolio.
And will we see further cuts in finance costs as well?
So we have seen constant reduction in our interest rate over the last 4 quarters. We still think there's significant headroom for us to lower our cost of financing. So absolutely, you would expect some reduction in financing cost over the next few quarters.
Ashish, last question from our end. Number one, any update as far as the Navi Mumbai land bank is concerned? Any asset you're evaluating in Mumbai? And other than that, recent acquisition, Bangalore, Hyderabad, CapEx as well as timelines as far as turnaround is concerned?
So Navi Mumbai status quo, we actually don't have any change there. We would probably pursue the matter with the administration post the elections. In terms of Hyderabad and Bangalore, of course, that's a very exciting addition to the portfolio. We've added almost the potential to add about 500 rooms to our portfolio. But even more than that, it's important to understand that all of them is going into upscale space, where the revenue per key is almost twice that of the portfolio average. So these 500 rooms hypothetically have the impact of almost adding 1,000 rooms to our portfolio, which is about 25% growth. Now, if you see, there are 3 hotels in that whole acquisition bucket. One is operating as we speak, which is in Bangalore. We will rebrand this hotel in the next 18 months. The second would be the high-tech city, where we've actually taken an office building on a long-term lease. And this would be converted to a hotel and be ready to open in the next 18 months also. And the last bit is the new tower in the Bangalore Whitefield development, which will take about 36 months. So you would actually see these 3 acquisitions creating an impact on Samhi starting FY27, going up until FY29.
Okay, all right. Take that point. Thank you so much for joining in today and giving us all those details, Ashish. So that's the word coming in from Samhi Hotels. The stock is higher, up around 2% as we speak. And again, as CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on November 14th, starting 10 a.m. onwards, a power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only and only on CNBC-TV18.
Welcome back to Midcap Radar. Well, intraday gains that were seen by the market have been given up. All of the key indices now trading in the red. And one particular pocket of the market that's seeing quite a bit of selling pressure intensify is actually the FMCG names. Britannia will be reporting its numbers later today, but ahead of the results, the stock is down almost 6% in the intraday session. Along with that, other FMCG names like Marico, Dabur 2 are now trading near the day's lowest point. Hindustan Lever 2 is under some pressure even as we speak. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.